Good morning, everybody. Mark Whistler here with FXVolatility.com and WallStreetRockstar.com. And thank you so much, FX Street. Thank you, Adinda and Maud, Edzy, Super Rockstar as well. It's good to see everybody here. We've got Edzy, we've got JM, we have FX Trade, we have Rod, Jeff, William, Carrie, Pip Rider, Into the Sunset. Deshay, we have PA, Viv, Cox, Tamerlane, Adam, Kwuku, Mac, Rob, Bill, Jairus. I think it's being recorded already, Marcella. We have a run. Did I pronounce that right? A run. Mike, Trey, Mac, Creef, Che, Storian, Wolf, Fuji, Run, Anthony. Is this Anthony from Wall Street Rockstar? No, it might be a different Anthony. Sierra, Zool, KD, Dorix, Dudley, and Philip. Is this Philip from Wall Street Rockstar? Quay. Gotcha, Quay. That's great. Just call me Quay. Quay. I think in they pronounce it in French when you say yeah, in French is way, instead of we, way. Great, Quay. Again, Mark Whistler here, and I just took a brief disclaimer. At no point in our discussion today is any of our conversation a direct recommendation to buy or sell. In fact, this webinar is for educational purposes only, and it's meant to hopefully make volatility illuminated. And if possible, I will attempt to trade live and in real time. However, the account that I'll be trading is hypothetical. Why is that? That's for legal purposes, and to reiterate that today's webinar is for educational purposes only, and to further reiterate that at no point should you be attempting to make money based off our conversation over the next hour. So with that in mind, we'll go ahead and get started. And today we are going to discuss volatility and probability. How many people here are familiar with volatility, probability, incorporate volatility, probability into your trading? And how many people here actually look beyond the box, look beyond stock technical indicators to be able to find some sense of possible trading? And Mike, we will cover that in just a moment. What is it? That's the big question of the day. What is volatility and probability, and how can it actually help you trading? Well, here's what is so important. Foremost, most people are not even aware of the volatility probability paradigm because it is not actively coveted by your brokerage. Well, why is that? That is because your brokerage is taking the other side of your trade. And what we're talking about here is real information developed by real traders that really works. And as you're about to see, volatility probability not only gives us great insight into when trending will begin, but also when trending will end and when the lateral consolidation will ensue. And for the volatility probability trader, what you have is a leading indicator, unlike most indicators within the market, which are actually lagging indicators. So let's go ahead and talk for a moment about price action so we understand exactly what we're looking at on a day-to-day basis. Because also, if you've attended any of my webinars on VWAP, you'll understand that volume matters as well. Seriously matters. And many people will tell you that volume doesn't matter in Forex, and Forex is a blind market. It's untrue. Volume is absolutely important, and can not only help us identify when institutional program selling is in effect. And there's Elena, Super Elena. Elena is one of the best traders I know, by the way, who just showed up. So Elena should be teaching these webinars, actually, because she is brilliant, by the way, everybody. Elena and Meryl are super traders, and Meryl's here sometimes too, but I don't see him today. Anyway, and I think actually Marcel might be here too, maybe. There you are, Marcel, we have Marcel, are you here as well? If you are, perhaps speak up. Marcel is there's Mac, Marcel. Marcel is yes, there's Marcel. Marcel is a doctorate physicist. And a lot of the concepts that you're reading here, or that you're about to hear about, have actually have some fundamental underpinnings of physics and volatility probability, like the Newtonian law of motion, which is the second law of motion. I think it's second law. Force equals mass times acceleration. And we're going to go over that in a minute, too, and you're going to see how that can actually make our trading slightly more insightful. So it's great to have Marcel here, and he's a brilliant man, and of course Elena, super trader. Okay, so anyway, this is the fundamental concept here, and we're just going to go over a couple. We're going to go over a couple moments of understanding of volatility probability, and then we're just going to double check to make sure everybody understands exactly what you're really seeing on your chart, what price action is, and what exactly is happening on a day-to-day basis in the data that you're seeing unfold in real time. And as long as you truly understand the bold paradigm of the data that you're really seeing on your chart, you can navigate most markets profitably. So anyway, the fundamental concept here is that volatility and probability are distinct in historical descriptive statistics, in that we, in terms of a normal Gaussian curve, and I'll go ahead and pull this up. Maud, could you post a link to the Perceiving Descriptive Statistics report on FX Street? And I would encourage everybody to read this report, but on descriptive statistics, we have a thing called a Gaussian curve. If everybody's familiar, what a Gaussian curve is, it's a bell curve. And the bell curve basically says that there's a mean that splits in the middle, and the mean on either side of that mean we have standard deviations, and that's measuring all of the potential data that could show up on our in whatever time frame we're mapping. Well, why would Forex markets or equity markets be any different in terms of data than, say, if we were measuring stars in the sky? Well, really, they wouldn't, because what we're talking about is data. Data is data is data is data, and as long as we have a value of 1, meaning that there is data present, that we actually have the empiricism of data justified, we know that all descriptive statistics will generally hold true and hold the principles of descriptive statistics. That being said, on either side of the mean, we have standard deviations, which are meant to measure data from the mean. Well, what is the mean in terms of Forex? The mean is your moving average. And if I can measure one standard deviation on either side of the mean, I know that there is a 68% probability that all of the data will lie within one standard deviation of the mean. I know that there is a 95.4% probability that all of the data will lie within 2 standard deviations of the mean, and I know that there is a 99.7% probability that all of the data will lie within 3 standard deviations of the mean. Think about that for a moment. If you had an indicator, if you had something in this world that would show you where 99.7% of all of the trading data would show up, could that possibly help you in your trading? And if you did have such an indicator, how would you use it and how would you apply it to FX markets? Well, here's what's so amazing. You do have that indicator, and the indicator is called Bollinger Bands. Bollinger Bands are, unfortunately, John Bollinger is a idol of mine, and I think he's a god as far as markets go. But unfortunately, a lot of the meaning of Bollinger Bands has been lost by the name of Bollinger Bands. And it's my understanding that John Bollinger was on the Bill Griffith segment of CNBC a long time ago, and he was explaining Bollinger Bands to Bill Griffith, and Bill Griffith said, "Well, what do you call these?" And he stumbled and he said, "Bollinger Bands." And so that's how Bollinger Bands got their name. Well, unfortunately, Bollinger Bands are not Bollinger Bands, they're volatility bands. They're measurements of standard deviation actually applied to a chart. And what you're seeing right here on my chart, and this is actually a chart that's left over from our webinar the other day on Volatility Illuminated webinar. And what you have here is you have basically I've drawn 1.25 standard deviation, our first standard deviation Bollinger Bands. And these, we're not going to call them Bollinger Bands anymore today. We're going to call them volatility bands to make sure that we have our terminology correct. Well, at one standard deviation, what are we measuring? Well, remember, there's a 68% probability that all of the data will lie within one standard deviation of the mean. So if we look at our chart here, we know that descriptive statistics, that historical, even inferential statistical value is correct, because 68% of the data will lie in between these two yellow lines. Well, here's what's so great. If I go ahead and I take my my chart here and I add in a custom indicator, and we will just go ahead and put in, actually it's a stock indicator, everybody should have it, I believe. And we'll go ahead and put in our a 50 period 3.2, and the reason why we're doing 3.2 and not 3 is because in the actual application of the standard deviation formula to our charts, through the squaring of the exponent in the standard deviation formula, we get a multiplier effect, which actually makes bands expand and contract. However, at the same time, it also causes us to lose a little bit of data. And so we must, if we want to measure 3 standard deviations, we must actually put in 3.2. If we want to measure 2 standard deviations, we must put in 2.2. So that's that 0.2 that helps accommodate for the data loss in actually transferring the formula to our real-time charting data. So if I go ahead and I map now our green lines here, which you can see, we'll make these just a little bit bigger so you can see them. We are looking at third standard deviation. And you can see we have third standard deviation Bollinger Bands, volatility bands on our chart. Now remember what I said a moment ago. There is a 99.7% probability that all of the data will lie within 3 standard deviations of the mean. How much of our data here, if we look at price in terms of data, how much of our data is outside of the third standard deviation? Almost none. Remember, there is a 99.7% probability that all of the data will lie within 3 standard deviations of the mean. And you're seeing that actually visually justified on your chart here. You're seeing that math justified. You're seeing, instead of just an indicator that I'm saying, why does it work tomorrow? Not just because it worked yesterday, because descriptive statistics tell us that there's a 99.7% probability that all of the data will lie 3 standard deviations from the mean. Stoyan, I'm so glad that you just asked that, because here's what we have to understand is that first of all, what you're talking about in terms of long-term capital, what we're really talking about here is one, we're talking about the rigidity of an institution that was using, I believe, the Levy theory to attempt to measure the risk parameters, 1. And 2, you're talking about the rigidity of a institution that didn't understand that the market is comprised of mobile subset distributions. And so when I look at this chart here, and we'll just go to the 4-hour chart, here's the amazing thing, is that when we actually look at what's happening here, we see that at almost no point do we see a breach of this third standard deviation. Well, okay, everybody who when they hear descriptive statistics, they think of things like long-term capital, and they think, okay, well, what if we hit a 5th or 6th standard deviation outlier? Well, let me ask you this, Stoyan. How can you hit a 5th standard deviation outlier if your distribution is moving? You can't. But you can hit a 20th standard deviation if you've been so rigid or so credulous to assume that your distribution is immobile and it's not moving. So where we see long-term capital management, we see other funds who fail with descriptive statistics, where they fail is that they assume that they have to measure the risk parameters by a rigid, immobile distribution. But when we understand that distributions move and that all of market movement is nothing but a series of subset distributions moving up and down, then we can begin to use volatility and probability on our side. And we can begin to use the principles of volatility, probability, and descriptive statistics to help us trade even on an intraday basis. And it's amazing and brilliant, and it works. And so we'll go ahead and we'll jump into some of the fundamental principles of volatility, probability, and how that actually applies to intraday trading. First of all, though, I just want to take a moment here and just go ahead and cover what we're actually seeing. Who can tell me what price action is? Who knows what price action is here? I know a couple people do. And then also, we can, during this webinar, we will break myths. We will go ahead and we will tear apart what you've been taught as valid as far as markets and trading goes. We will take that apart and we will put it back together in the proper manner, because a lot of the information that you've been taught has set you up for failure from the get-go. Price action. Okay, what? Begin contraction on the left side. On the left-hand side. What was that song from a long time ago? Past the doji on the left-hand side? I think it was. Anyway, so we have ranging consolidation, emotion of humans. We have, again, contraction on the left-hand side. What was that other song? Everything you own in a box to the left. Everything you own in a box to the left. We've got definitely are great. However, what price action is price action. Do I take regression I take my own mental regression into consideration every day, Philip? Of course, yes, absolutely. We have price action movement in a market based upon sales and buys. Yes, Mike, you are a genius. That was a great answer. Thank you for that so much. Because really, we are talking about the movement, the data that's unfolding on your chart, which is, and as Mike said, based on sales and buys. So what happens is we get to the chicken before the egg argument. Does a transaction occur before a print occurs on your chart, or does a print occur on your chart before an actual transaction takes place? Who can answer that question? It's pretty simple, I think. Of course, a transaction, a physical buy or sell, must take place before data can show up on your chart. So we know that the data that shows up on your chart is, in terms of the chicken before the egg argument, is the egg after the chicken, meaning that a transaction must first take place before data can show up. That also means that volume is critical, because without volume, there is no price action. However, there can be, we can have a bid and an ask. We can have we can visually represent a potential price offering and, of course, bidding. But however, for the actual price to show up, for the print to show up, a transaction must take place. And of course, there's the argument that perhaps the two are simultaneous. But the problem is that we can have a transaction without a print on the chart, but we cannot have a print on the chart without a transaction. So what I'm telling you is volume matters, always. One. And two, it's important for you to understand that the representation that you're seeing on your chart is actually the representation of transactions. I know that sounds simple, but stick with me for a minute and you'll understand how important that is. So what we have to understand is that the representation of the data that you're seeing on your chart is actually the visual inference of all of the transactions that have taken place. So if I look at, I measure volume in terms of ticks if a tick comes after a variable volume. Well, think about it, PA. Can you have a tick without volume? Can you have a tick without volume? Can you have volume without a tick? Yeah. So, well, here's the point is that what is a tick? We're talking about the measurement of time. We're talking about in terms of the way data unfolds, because time is linear. and is always skewed, which is also why we measure subset distributions, because we know that if we were to measure all of the data over a long period of time, it would be skewed. And so we have to pluck, according to the central limit theorem, pluck subsets of distribution out so we can actually have some sense of a normal Gaussian curve. And also to answer your question, how else would you measure volume? Better yet, how would you measure time? How would you measure inches? How would you measure meters? We must have some type of measurement in order to be able to decipher in some proper order the actual data that's unfolding. So right, exactly. And PA, that's why in the VWO Formula, which you'll also note that I posted on FX Street, is why we measure VWO via ticks. And that's what it is. You're right, it is a tick count. But the bottom line here is that, and I don't want to, we're wasting time, unfortunately, but the bottom line here is that we must have volume in order to see the price data unfold. And ticks make up minute bars, and minute bars make up 5-minute charts, and 5-minute bars make up 15-minute bars. No, that is incorrect as well, PA, because if you think about the way VWAP is calculated, and now we're splitting hairs, and we'll go ahead and waste time, and we'll take away from volatility probability to make sure that we clarify this for you, PA. But what we're talking about in the VWAP formula is how is VWAP calculated? First of all, can you tell me that? And VWAP is calculated by taking and multiplying the actual price data times the volume, and then summing all of the periods and then dividing by the total volume. And so what we do basically is we're able to have an inference of whether there was actually more volume dollars traded at any particular period, which is why institutional traders actually use things like VWAP, TWAP, LHOC, low, high, open, close, for a benchmark of performance, unlike a regular moving average. Because what is a moving average? A moving average is nothing more than the actual midpoint of the data that's unfolded on the chart. And if you don't believe that obviously that volume affects VWAP, then I encourage you to apply VWAP to your chart, and you'll see that VWAP does not act exactly as a moving average does. And in fact, in periods where the market starts to roll over or the market starts to rally, VWAP sometimes will stay flat. Well, why would VWAP stay flat if volume didn't matter, and tick if everything was just we were just incorporating some volume? Well, the reason why VWAP would stay flat is because if the market was rallying, and even though our moving average is moving up, if there isn't volume dollars buying, because that's how VWAP is calculated, and what it takes into accord is actually the volume dollar transactions at any particular period. There's also a mod. I'm not sure if you could post the link for the VWAP session that we just recorded a week ago. I think it would be good for you to watch, PA, and I think you'll also understand. And you can also download the VWAP formula, and then you can actually post it yourself. And PA, can I explain this in any greater detail for you? Because I want to make sure that all of this is really understood. Are you sure, PA? I think that you should retake a look at that formula, because you'll see that it doesn't just weight alpha of the EMA, because an EMA just simply puts more weighting on the more near-term data, and an EMA does not take volume into accord whatsoever. So anyhow, we will get back to volatility probability here, and we'll try and get back to the original webinar that we started on. So it's a little frustrating, I have to admit, but okay. So we, on a volatility probability basis, we know that there's a 99.7% probability that all of the data will lie within 3 standard deviations of the mean. And by the way, I would. in retrospect, it's not frustrating. And P, I want you to ask any questions that you want, because that's what this is here for. This is here to try and help you, to see the reality of FX and what you're not normally told, and to help bring some things open that are held back from the retail trader, for the most part, from brokers, from normal lines of education, and from normal methods of trading, of a lot of the data that you normally receive. And Maud or Dinda, if you could post the link to VWAP, that would be great. And I've actually also put it on FX volatility as well, and you can grab that right there. And then, of course, it is also on FX Street as well, so you can get it in both places. Just FYI. Okay, so we know on a volatility probability basis that a 99.7% probability all of the data will lie within 3 standard deviations of the mean. So we know that descriptive statistics holds true in terms of how we actually see the measurement of subset distributions unfold on our actual charts. And so if we look at our chart, if we actually look at the pound US dollar on a 4-hour basis here, we see, and I just want to make sure you guys can see my chart okay, we know that we're measuring basically a 50-period distribution, and we're measuring 3/3 standard deviation of the actual 50-period distribution. Can everybody see that? So right here I put in Bollinger Bands, Volatility Bands, 50 periods at 3.2 standard deviations. And so how would I actually use this data? How would I go ahead and incorporate this data into my trading to be able to have some semblance of what's going to happen on an intraday basis? Well, let me ask you this question: what if I'm measuring 50 periods of data and I'm measuring 20 periods of data, which of those two, because those are subset distributions. We have a 50-period distribution and a 20-period distribution. Well, I'll go ahead and I'll put in the 20-period distribution here as well. If I'm measuring a 50-period distribution and a 20-period distribution, which of the two would have more extreme highs and lows? The 50-period or the 20-period? Right, Flo. Good, great, wonderful. And Elena, of course, it's the nail right on the head. Thank you so much. And Dorix, it's actually the smaller one, or excuse me, the larger one. I just got confused. I wasn't paying attention to what I was saying. The larger of the two distributions would have more extreme highs and lows. Or in theory, it would. Now, and Dorix is right there. Why is that? Why would a 50 period have greater probability of higher highs and lower lows if we just plucked one chunk out here? So if we plucked on my chart here, if I were to pluck out 20 bars, and I'm not actually measuring the 20 bars here, I'm just going to put these blue lines. Assume from blue line to blue line, this is 20 bars, and then assume from blue line to, we'll do from blue line to orange line, assume we have 50 periods. So we have a 20 period distribution, and we have a 50 period distribution. In the 20 period versus the 50 period, which one would have greater probability of higher highs and lower lows? Of course, the 50 period would, and the justification for that is because we're simply measuring more data. The more data we actually take into accord, the more data we actually measure, of course, as time goes on, the greater the probability of higher highs and lower lows. So we know that when markets are stable, when all things are neutral, in theory, if everything is the way it should be and the markets are calm, then the 20 period distribution should be inside of the 50 period distribution. But because of the multiplier effect and the standard deviation formula, we know that we get the expansion and contraction effect of volatility bands, aka Bollinger Bands. So if you have, if you're measuring 20 periods and 50 periods, and all of a sudden volatility kicks up, which distribution is going to move quicker, the 20 period or the 50 period? Who can answer that? I know you guys know it because everybody in this room is brilliant. Yes, exactly. The 20 period, and the reason for that is because we're just measuring less data. So the analogy that I use in Volatility Illuminated is that, say you're driving by a field in Kansas and there just happens to be a herd of hippos grazing, and you're driving by in your old beat up truck, and all of a sudden your truck backfires and startles the herd of hippos. Well, which hippos are going to be out in the front of the herd? The big ones or the little ones? Probably the little ones, because the little ones have less mass to move. And so basically we know on a volatility probability basis, and also just on an overall, in the principles of physics, that everybody in this room would find it easier to push a wheelbarrow of cantaloupes up a mountain versus a dump truck full of lead. Well, the greater the distribution, the more lead it has. If we're measuring 1,000 bars of data, we know that it's going to take a lot more force and a lot more mass to move that distribution than it would the 20 period. So we know, just to kind of go back to the earlier question that was on long-term capital management and the question about the 20 standard deviations. Well, if I'm measuring 5 periods of data and I know that mean is mobile and I know that mean is actually going to move up, so if the data moves up, I know the mean is going to move up as well because a moving average moves. It is a mobile mean, which means that we have a mobile distribution, and as long as that distribution is mobile, then we're not likely going to see a breach to the 5th, 6th, 7th, 8th, 9th standard deviation because the distribution is moving with the data. It's only when we actually believe that the distribution won't move that we actually see those breaches of the 3rd standard deviation. Well, back to our original concept there, is in terms of hippos. If obviously if the truck backfires and the herd's about to move, the little guys who have less mass to move, who are quicker, who can run faster, are going to bolt first. And thus we see an expansion of short-term volatility outside of long-term volatility anytime markets are about to move rapidly. And then when we talk about the principles of volatility and probability, and we'll just go back through this chart, and you can see that basically whenever we start to see a big move up or down, we're always going to see short-term volatility begin to expand and outside of long-term volatility. Well, again, why is that? It's because there's just less data to measure, and so short-term volatility can spike quicker than long, really, perhaps be ready to move fiercely. And if we understand that a short-term volatility, yeah, we'll pull up that chart, Ed, just so we're all on the same page. Yeah, I sure can, Mike, because that's what I'm here for, and I'm here to give you those examples. But I just want to cover one other concept here of volatility probability really quickly that's so important for us to know. First and foremost is if we have to understand that these things called Bollinger Bands, that and again, I love John Bollinger, he's an idol of mine, that because of the name, the general investing public doesn't understand what they're seeing. They're seeing the measurement of they're seeing the actual application of standard deviation to the real-time data that's unfolding on their charts. Well, it's again because of the multiplier effect in the standard deviation formula, squaring of the exponent, which creates this expansion and compression. Because when we're not seeing volatility, the multiplier effect means that the bands will suck themselves back in, sort of like if you were to suck in your tummy, if you were trying to make yourself look a little bit taller and a little bit thinner. But then when you obviously get in motion, if you were running down the street, you can't really run and try and stuck in your tummy forever, you have to kind of, if you really want to run fast, you sort of have to forget about it. And so that's kind of what we're having here in terms of the expansion of volatility bands. Is basically we're seeing short-term volatility say, look, I got to start moving. I'm not going to try and look nice and tucked in. I'm just going to let it go and start running. And that's, we see the expansion of volatility bands, obviously, and again, that is derived by the multiplier effect in the standard deviation formula as applied, as Bollinger Bands apply the standard deviation formula to our real-time data. Well, here's what's so important. If volatility is expanding, what does that mean? I sure can, Philip, and I would be happy to do that. Let's just get through this one fundamental point, because this is I know we all want to just know, okay, when do I get in, when do I get out? And we all want to know, okay, well, just tell me, hey, Whistler, just tell me how to buy and sell. Just tell me what I can look for on the chart. You have to understand the theory behind what you're seeing. You have to understand what's happening. Otherwise, you'll never be able to apply the information correctly. So what we're going to do here is we're going to make sure everybody here understands the theory of volatility probability, and then we'll actually go through a few buys and sells, and we'll look exactly or show you exactly what you should be looking for. And it's not as simple as red line crosses blue line, and there are this is going to take some thinking on all of your parts, and of course my part on a day-to-day basis to be able to see volatility probability work. And in fact, the euro US dollars is setting up a trading opportunity for us right now. And if opportunity presents itself well in the next 20 minutes, I will trade it for you because we do have a volatility probability opportunity right now as well. So we know that when volatility is expanding, prices are moving. Well, here's what's so amazing. Hey, Boyke, good to see you, Boyke. Is it not true that the bands reflect the price action? So why do we need them? Well, why do you need price action? Why do you need to know what prices are? Prices are still a reflection of the subset distributions, Boyke. If we're measuring, we can't just measure volume alone, and we have to have some way of measuring those subset distributions of transactions that are unfolding on the charts. And so how else am I going to measure subset distributions? So what the volatility bands give me the ability to measure the subset distributions. We have a 50 period, a bigger distribution, and we have a shorter distribution here. And Adinda again, or Ahmad, if you guys have a moment, if you could post I'll just show the actual chart. If you could post the link to the descriptive statistics report, then I think I can pull it up really quick if you have a moment to access that. And then and for everybody here, we see that when volatility expands, price action moves. What happens when volatility is compressing? Elena knows this. So does Marcel. When volatility is compressing, there is exactly, Mike. If volatility is compressing, we cannot trend fiercely. We can slowly edge up or down, but we cannot trend fiercely if volatility is compressing. And we'll just walk through the chart and you'll see it. And so what we're talking about here is really the expansion and compression of energy all throughout our day and seen in subset distribution. So check this out, and once you see it, you're going to be like, holy smokes, that is so cool. We see, look, volatility expansion. Expansion, does everybody see that? We see volatility expanding, trending, volatility compressing, directly lateral trading, volatility expanding, trending, volatility compressing, directly lateral trading, volatility expanding, a little bit of trending, volatility compressing, directly lateral trading. And then we get just a little bit of expansion right in here, and we get this little move up, and then we start to roll over, and we see this directly lateral trading. Volatility expanding, trending, volatility compressing, lateral trading, volatility expanding, trending, volatility compressing, lateral trading. Does everybody see this? How amazing. Elena, thank you so much. Elena is such a rock star. Thank you so much for posting that, Elena. The principles of volatility probability are rock solid, and we're talking about descriptive statistics. Because if I were to ask anybody here why does what is really the why do most technical indicators work? MACD, stochastics. If you don't understand the mathematical underpinning of what's really happening, the only real justification you have of why those indicators work is because they worked yesterday, and that's it. And because they worked yesterday, they should work tomorrow. Well, unfortunately, that's not good enough for any of us because we are better than that as traders. And CR, what I have here is I have a 50 period set at 3.2 standard deviations, and I have a 20 period set at 3.2 standard deviations. And we can use different subset distributions. Sometimes I use a 14 period distribution. Sometimes I look at a thank you so much, Elena. Super Elena. And Super Mud. I love it. Yeah. And we have sometimes I use a 34 period, sometimes I use a 50 period. But there's more to the story here. So let me go back and just make sure I'm not missing any questions here. Euro US dollar break below 1.4211 short. If break above 1.4265 long. 4265. Okay, what we're talking about there really is yes and no, because the bottom line is that we have now compressed here, and we will know when price action is literally on the move because short-term volatility will begin to spike outside of long-term volatility, one, and two, we will actually begin to see a breach of those volatility outliers. And we'll see basically we'll tag the third standard deviation. If we hit the third standard deviation on the 50 period, chances are we could continue upward, assuming we're able to stay above that initial volatility point of the third standard deviation, which obviously would be measured right in here at 1.4269. But we wouldn't want to, right when we first immediately tag it, we wouldn't want to just assume that is the direction we're going to move, because we could touch that third standard deviation and then reverse downward. So basically what we want here is we also want to have some greater idea or semblance of trending, which of course we can find through using the quad CCI strategy, or even looking at other various aspects of our subset distribution. So, but I do know if I were to take a long position here and we did violate the third standard deviation on the downside, 1.4193, it probably would not bode well for me to hold that trade long while we are touching short-term volatility on the downside. Well, here's what's so important, and I covered this in the webinar on VWAP, which you can find a recording of, is that we have the theory of Dr. Watermelon Stuffer, and why benchmark trading in terms of VWAP is so important, and why it's so important to understand where VWAP is. Because the problem with and this will go back to PA's earlier questions about tick data. The problem with the exchange process is if I have $40 billion worth of order flow to work, how can I shove that entire $40 billion worth of order flow through one tick or even 1 minute bar? No, I can't. And so what I have to do if I'm an institutional trader is I have to break up those orders into little chunks, which is known as iceberging, and I have to slowly kind of put those chunks, those smaller chunks, into the market all day long. So basically, what we have is we have a situation where the order flow that enters markets on an institutional basis is larger than the whole of the exchange process, meaning that I cannot just shove $40 billion worth of orders through a 1 minute bar. I have to slowly break those up. And so institutional traders, sell-side traders are contracted to work that order flow and to do it adeptly on a day-to-day basis. Well, how are those institutional traders measured? How is their performance measured? Well, their performance is measured on VWAP. And so if I'm in a fund XYZ and I call my boy on the floor and I say, hey, Joe, why don't you work $40 billion long for me, get VWAP or better, then we know that when that VWAP indicator, when that moving average is there, if I have achieved prices that are below VWAP or better and we've rallied throughout the day, I've done a good job of trading. So when we start to see a massive spike up, we know that basically VWAP is not going to move as quick immediately because, of course, it is a moving average still at some semblance it's taking in accord all volume traded, and so it's going to move up slower. And so when we have an initial first spike, we don't have to always run to chase that market, because chances are we're going to come back to VWAP, and when we come back to VWAP, that's where the institutional guys step in and start buying. So here's what I'm going to look for. One is I'm looking for an expansion of short-term volatility outside of long-term volatility. Two, I'm looking for obviously a series of subset distributions which have very little mass, and we can see that basically my 20 period has not a ton of mass here. We can see that in the sideways consolidation, and the 50 period has also consolidated in mass as well. And so when I start to rally up here, if the move is real, we're going to tag the third standard deviation, and chances are we'll actually probably pull back into VWAP or the moving average, and then we'll take off again. So I don't immediately have to jump in and chase. I can actually wait to see whether the move will stick or not, and then buy the pullback. So that obviously is how we basically remain patient and not go ahead and chase markets. But when I see short-term volatility expand outside of long-term volatility, what I also know is that basically when short-term volatility compresses back underneath long-term volatility, and here's the bottom line. When we see short-term volatility expand outside of long-term volatility, I should be looking for some sort of quick price action. When I see short-term volatility compress back underneath long-term volatility, that means that lateral trending will ensue. And you see that from the time we compressed, we really trade laterally here until we see short-term volatility begin to expand again. And that's when we start to see a little move up. And I'm picking this particular period right here because it is with the removal of the stop rule, we're seeing greater volatility, and not all moves are going to be as clear as kind of these big falls. So I want to pick something here that's going to be a little bit less clear, so you can see what you should be looking for. But if we just measure ascending support and descending resistance on volatility, and we're keeping a close eye on volatility expansion and compression, when volatility starts to compress, we need to understand that lateral trading will ensue. Not until volatility begins to expand will trending start. It is literally that simple, because the principles of descriptive statistics tell us again that there's a 99.7% probability that all of the data will lie within 3 standard deviations of the mean. And of course, what we're looking at here is we're looking at a 50 period and a 14 period. And so we know that based on the multiplier effect and the standard deviation formula, that when volatility begins to collapse, we will see the occurrence happen exactly in the compression of volatility in our charts. We'll look at what's happening with short-term volatility right now in the Euro-US dollar. Why am I not chasing the Euro-US dollar as we're trading towards the top of the range? Because I don't know about anybody else here, and I'm just going to measure this by drawing a brown line and a brown line to basically frame the short-term volatility here. I don't know about anybody else here, but I'm not really seeing an expansion in volatility here. Are you? What we're talking about here is real volatility probability. So what we're talking about here in PA. Are your charts? Is the price data on your chart dramatically different than what an institutional guy sees? I mean, basically, is the institutional person's is he looking at the Euro-US dollar trading at like 1.41, 11, 14 now? Right? Nope. Because the bottom line is that when you're seeing data here, you're seeing all of the volume data of your broker, and your broker is basically isn't just serving you, the retail trader. He's actually running his own risk management trades as well. And you're seeing all of the data, the volume data that is happening for that broker running it through the through the clearinghouse. So what we have here is the fundamental problem, and I will in the book, I'm trying to think of the name of it. It was the book I mentioned it in Volatility Illuminated. I think it's the institutional. The title is something similar to institutional issues with order flow. I might have that title completely goofed up, but what we have is we have regulators and we have institutional traders who step in, and they say the problem with the retail trader is the retail trader believes that his platform is nothing more than a vending machine. Order in, position out, order in, position out. And the retail trader thinks that he literally is just looking at a vending machine. He doesn't understand what he's really looking at is a gateway to liquidity. It is a gateway into the exchange process. And PA, I can't decide if you just want to be right or you're really curious. I can't decide if you really just want to have an argument because you want to argue and actually try and look smart, or if you really have some serious questions here. Because if you take a moment and sit back and think about what's really going on, and you really understand how trading works, if you just think about the exchange process, and there's no doubt in my mind, PA, that you're not a brilliant person, and I think I appreciate your questions because it's good. I mean, it's good for you to ask. Is the broker sending out actual volume in terms of lots bought or sold, or do they just send out the number of times price changed? Well, in terms of what you're actually seeing here is you're seeing the from the retail perspective, you're seeing the average price of all transactions in whatever ticker period. But to think about it, is the bottom line is that you are still seeing a measurement of volume. If I know that the average price of all transactions in that period are, if I have many less transactions occurring over quite a few, then what does that mean? If say if we're in a rapidly ascending market and there's little volume, what does that really mean, PA? It means that not that there is a absence of buyers. It means that there's an absence of sellers, that people have stepped off of the offer. You need to start thinking like an institutional market maker. If I'm holding a market down and I just step off of the offer, what's going to happen? I basically just stepped out of the way so you can move through me, which is how markets move up or down. Obviously, we have more buyers than sellers and more sellers than buyers. Well, here's what you have to understand is that's why VWAP is so great, because what we're talking about is we are talking about using all of the volume incorporated. If you look at the actual formula for VWAP, you'll see that basically I'll go ahead. I think we're running out of time, but again, I'm not going to be able to finish the webinar on volatility probability, so we can answer these silly volume questions, and I'll go ahead and do that right now. Give me a moment to pull up the book, please. Boyke Dharma is wonderful. Okay, so we'll go ahead and PA, for future reference, there is a webinar on VWAP that I've recorded, and it might have been a good idea if you haven't watched that one to watch that one before asking questions about VWAP in a webinar about volatility probability. Just FYI, having done your homework. And I appreciate your questions, and if I don't want to sound too frustrated, because I mean this time is for you, and I want to provide you with the answers that you need. Okay, can everybody see my screen? Okay, and we have about 2 minutes to go over this, so we'll go ahead and just cover this part here. Okay, in the VWAP formula, of course, we have yep, and we have to. Okay, yeah, actually, we have to go. Derek is here already, so. Please just reference the VWAP formula, and what you'll notice immediately is that basically VWAP actually gives us a greater weighting on the shares traded in the current period over just a moving average. And by the way, Derek Fry is amazing and incredible and a great trader, so please everybody listen very closely to his information, and sorry for running a little over my time. Everybody, please have a wonderful day. And PA, I encourage you to watch the webinar on VWO. I think it'll answer a lot of your questions. Thank you so much.